to the next topic that's called partnership. Okay, so everyone should keep the spectrum in their mind. On one hand, we had a sole trader, which is a single entity that was running the business, making all the decisions, taking all the profits. Then we looked at limited companies, where a company would go out, issue shares, take money from the market, and you can have hundreds, thousands of owners over here in the form of shareholders. We now move to the next entity, which is called a partnership. Okay, so I have explained this earlier, but we'll go into detail over here. A partnership can be an entity that is managed between 2 to 20 partners. So I can say a partnership is formed when partners would gather together to form a business with the intention of making a profit. Alright, so that's the aim of a partnership. It lies directly in the middle between sole trader and limited companies. Okay, but first thing first we need to address is that when there is a sole trader, he would take up all the profits, he would withdraw that. When there is a limited company, then a company or the board of directors would pay out dividends and no one would be entitled to any drawings. But what about a partnership, which again does not operate like a limited company, but there are partners that would be running the business? How would they decide how to keep the profits? Who gets what? How much can you withdraw? So all of this has to be decided when you form a partnership. In order to decide this at the time of forming a partnership, we draft something called a partnership agreement. So when a partnership agreement is drafted, it would list down all the essential details. For example, so these are the important partnership agreement terms that we need to state down. So the first one I would say is the profit and loss sharing ratio. How would profits and losses be divided amongst partners? Interest on capital. So for example, if one partner has invested more than the other partner, how would that partner be compensated? So the partnership out of its profits would pay interest on the amount of capital invested. So if partner A has invested more than partner B, he would get a higher return which compensates him for his additional capital. Otherwise, for example, the partner that has invested more might want to withdraw his capital as well. So we need to compensate them for higher capital contribution. Interest on drawings. We need to also penalize partners that are withdrawing more. So if your drawings are high, you would have to pay a higher interest to the partnership. So I can say in interest on capital, that is subtracted from profit because the partnership is paying it to the partners. But with interest on drawings, the partners are paying this amount to the partnership, so the profits are increasing. Salaries. So if any partner is involved in management, they would be compensated for their opportunity cost and time by being paid a salary over here. Interest on loan. Again, interest on loan is something that you need to pay a partner if a partner has given a loan to the business. As a result, if they would have invested their money elsewhere, they would have opportunity cost as well. So again, interest on loan will be paid out of the partnership profits as well. That's also an appropriation.